Right now, as we speak, shares of Nauticus Robotics, trading under the ticker symbol KITT, are sitting at $1.24, down approximately 20.5% in today's intraday session. If you are watching the charts this very second, you are seeing a stock that is battling to find support after one of the most explosive single-day moves we have seen in the microcap robotics sector all year. Just yesterday, this equity closed at $1.56, marking a massive surge that had retail traders across every major platform scrambling to understand the catalyst. Today, the reality is setting in, and the price action is volatile, swinging between a low of $1.21 and a high of $1.46. The market is currently open, and the red numbers on your screen tell a story that is far more complex than simple profit-taking. This is a classic battle between the expectation of a sustained breakout and the harsh reality of financial structuring. When you look at a stock like KITT, the expectation, the narrative that drives the initial buying frenzy, is almost always rooted in the idea of a massive technological breakthrough or a sudden shift in business viability that justifies a valuation reset. Investors see a robotics company with government contracts and futuristic technology and immediately draw parallels to the early days of Tesla stock, hoping they have found the next massive multi-bagger before the rest of the world catches on. They expect that the news hitting the wire is purely positive, a signal that the company is out of the woods and ready to scale. Today, the reality is setting in, and the price action is volatile, swinging between a low of $1.21 and a high of $1.46. The market is currently open, and the red numbers on your screen tell a story that is far more complex than simple profit-taking. This is a classic battle between the expectation of a sustained breakout and the harsh reality of financial structuring. When you look at a stock like KITT, the expectation, the narrative that drives the initial buying frenzy is almost always rooted in the idea of a massive technological breakthrough or a sudden shift in business viability that justifies a valuation reset. Investors see a robotics company with government contracts and futuristic technology and immediately draw parallels to the early days of Tesla stock, hoping they have found the next massive multi-bagger before the rest of the world catches on. They expect that the news hitting the wire is purely positive, a signal that the company is out of the woods and ready to scale. The reality, however, is often buried in the fine print of SEC filings and debt agreements. What we are seeing today with Nauticus Robotics is the market digesting the specific terms of their recent financial maneuvering. The surge yesterday was driven by the announcement of a debt restructuring and a $250 million equity facility. To the uninitiated, this sounds like a massive influx of capital that solves all near-term liquidity issues. But the smart money, the institutional players using sophisticated tools like Schwab Intelligent Portfolios or proprietary algorithms, understands that an equity facility often comes with the caveat of potential dilution. The reality impacting the stock price right now is the fear that existing shareholders might see their ownership percentage shrink as the company accesses this new capital line to keep operations running. Let's analyze the volume because it is absolutely critical to understanding the psychology at play here. Yesterday, over 150 million shares changed hands. To put that in perspective, that is multiples of the company's entire float. This indicates a massive rotation of the shareholder base. The traders who were holding the bag from higher levels likely used the liquidity to exit, while a new wave of speculators entered, hoping for a continuation of the momentum. Today's volume is still elevated but showing signs of exhaustion as the initial euphoria fades and the math begins to matter more than the hype. When you see this kind of action on a platform like Robinhood, where retail sentiment can drive prices significantly away from fundamental value, it creates a feedback loop. You have traders looking for the next NVIDIA stock, ignoring the fact that Nauticus is a microcap company with significant balance sheet challenges, not a trillion-dollar chip giant with massive free cash flow. This disconnect between what the company is actually worth today versus what traders hope it will be worth tomorrow is exactly where the opportunity and the danger lies. The core of the recent news that sent this stock flying is the restructuring of debt into preferred stock and the securing of that large equity line. On paper, this cleans up the balance sheet. It removes the immediate noose of debt repayment that was choking the company's ability to operate. This is why the stock doubled yesterday. The expectation was bankruptcy is off the table. We are saved. But the reality, which is dragging the price down today, is that preferred stock often carries superior rights to common stock, and equity lines are essentially a license to sell new shares into the market over time. This creates a persistent supply overhang. Every time the stock pops, the company may utilize this facility to raise cash, effectively capping the upside in the short term. It's a necessary evil for a company that is burning cash to develop cutting-edge technology, but it's a wet blanket on the stock price that you simply cannot ignore. Now, I want you to pause for a second and think about your own portfolio. Are you holding this because you believe in the long-term future of ocean robotics, or are you just chasing the green candle? Comment below how many shares of Nauticus Robotics you currently hold and what your average entry price is. It is fascinating to see the distribution of holders in these high volatility plays, especially when the price action is this violent. Let's shift gears to what Nauticus Robotics actually does, because the business model is genuinely fascinating and stands in stark contrast to the financial engineering we just discussed. They are not just building robots, they are attempting to fundamentally change the economics of the ocean economy. Their flagship product, the Aquanaut, is a tetherless, autonomous underwater vehicle that can transform into a manipulator to perform complex tasks. Traditionally, subsea work requires massive ships with large crews and heavy hydraulic robots tethered to the surface. This is expensive, dangerous, and carbon-intensive. Nauticus is pitching a reality where a small, battery-powered robot can do the same job for a fraction of the cost and with zero emissions. This is the Tesla stock argument for the ocean, electrifying and automating a legacy industry. They also have the Olympic arm, an electric manipulator arm that can be retrofitted onto existing remotely operated vehicles, and the ToolKITT software, which provides the autonomy and intelligence. The expectation here is that the offshore energy, wind, and defense sectors will rapidly adopt this technology, leading to massive recurring revenue streams through their robotics-as-a-service model. Investors look at the total addressable market of the blue economy and see trillions of dollars. They envision a world where fleets of aquanauts are inspecting pipelines, servicing wind turbines, and conducting mine countermeasures for the Navy without a human in the loop. It's a compelling vision. However, the reality of hardware development is brutal. The ocean is an incredibly hostile environment. Salt water corrodes electronics, pressure crushes weak seals, and communication is difficult. Developing these systems takes longer and costs more than almost any software startup could ever imagine. The gap between a working prototype and a commercially scalable fleet is filled with broken parts and failed tests. This is why the cash burn is so high and why they needed that $250 million facility. The market is currently punishing the stock because the commercial rollout has been slower than the aggressive projections made when the company first went public via SPAC. Comparing this to the broader market context, it is important to understand where KITT fits in the landscape of investment options. If you are using a service like Fidelity Wealth Management or looking at Fidelity Mutual Funds, you are likely not seeing this stock in your recommended allocation. This is a high-risk, high-reward speculative asset that belongs in the small play portion of a portfolio, not the core retirement holdings. It is the type of stock that day traders on the Fidelity trading platform or users of the Fidelity mobile app might watch closely for intraday swings, but it lacks the stability that long-term investors usually seek in Fidelity ETFs. Similarly, if you are using SoFi Invest, you might see this trending due to the volume, but the SoFi Robo-Advisor is certainly not going to auto-allocate your funds here. This distinction is vital. You have to know what game you are playing. Are you investing or are you gambling on a volatility crush? The recent earnings report paints a picture that reinforces the tension between the dream and the data. The company reported a net loss of over $6 million in the last quarter on revenue of just under $2 million. While revenue is growing, the cost of generating that